90% of days, January 12th, 2024, 90% of days break out of the opening 18 bar range. And you can see today was part of the 10% of days that does not go below the low of the 18 bar range or above the high of the 18 bar range. So you don't see that all that often. One of the reasons we reversed here is the daily chart. If you look at the daily chart, we got a big pullback yesterday, but probably not going to last. This will probably be strong enough to get a second leg down, but it's not going all that far down. And you can see if you take yesterday, what's the midpoint? Start over here. And this is the high. And that's pretty much exactly what we reversed at the midpoint. It was a trading range day, so it makes sense that there was support at the midpoint of yesterday. But I think, in general, when you're in a trading range, it makes sense to look for support or resistance at 50%. I'm not sure if this was a 50% pullback. I haven't looked. It looks like a little more. Yeah, a little more than 50%. But I thought there were a lot of other reasons why we pulled back this far. One of them was we had a triangle right here. You can see. It's kind of hard to see, but one pullback, two pullback, and then the third leg, we got a big surprise on 41. But 41 was basically testing the low of 25. And, if you're buying above, 41. If you're buying above 41, you're buying right where bulls got trapped on 25. So they're probably going to be looking to get out. You can see that's exactly where we touched on 42 before we found sellers. But then we got an inside bull bar on 43. So you can buy looking for a measured move up. Generally on a trading range day, you should use the more conservative measured moves, just bodies without tails. And you can see we got a measured move up to here. And is that exactly why we reversed here? Maybe it's part of it, but I thought more relevant was this was the top of the trading range, right? We got a spike, pullback, and then this was a big bear channel. And we got to the top of that, which meant, this was the top of the trading range. This was the bottom of the trading range. Additionally, talking about conservative measured moves, you did get a spike from 59 to 61. You can take a measured move down with those three bars, and that's exactly where the low was. So spike, pullback, channel, exactly to that low. So, on trading range days, generally use more conservative measured moves, look to scalp more. Makes a lot more sense to do that than it does to hold and hope for a massive trend. That's probably not going to happen. Bar one, a bull bar, but a tail on the top. So not as good as it could be. Generally, I think, in this area, you're going to need a couple of really strong bull bars if you're going to look to buy. The daily chart was a bear bar, so the prior day. So that there are probably not too many buyers above there, probably sellers above. You can see bar two, a bull bar, but a big tail on the top. So you can more or less say it's a failed breakout above the prior day's high on bar two. Bar three, a doji bar, but, not great to buy above, not great to sell below. And then four is a micro double top with two. You can call it a micro double top with three. And it's a failed breakout of the prior day's high. And a lot of times at the prior day's high or low is where you get reversals. Four is probably, maybe 40% chance that that's the high of the day, 30 to 40% chance that when you get four, that is the high of, this is in fact the high of the day. Maybe it's more like 40 because the context is good. I'm not totally positive. And then you get bad follow through on five, but still okay to be short. It's not terrible follow through, but there's a big tail and a small bull body, a small bear body. So it could definitely be better. But it's enough follow through that traders see it and they start to sell the close once they get a bear follow through. And now they know that four wasn't immediately a trap. And you get a huge bear bar on six. Now, the problem with six is that it's really climactic. It's kind of like over here when these bars were getting really climactic. You knew that there was a deep pullback that was probably going to be inevitable. So it's kind of hard to want to sell down here. And if you recall in my video yesterday, I said that this was pretty strong, but I thought it was pretty reasonably possible that we were going to get a 50% pullback. And I was surprised that we went down immediately. Well, here we got the 50% pullback. You use this one as the 50% if you want to, or you could use just the bodies. And still pretty much right about there. Either way, traders after 7, they saw that it wasn't a very strong close, and a lot of traders were scalping out. And bears bought back their shorts and basically waited for limited order bears to come in on 8 around the 50% pullback. So I suppose the difference would be, this is a really strong close, and this is a pretty weak close. So it was more likely that when traders saw this, they were going to buy back their shorts and cause a rally. But I still wasn't in love with this bad follow through yesterday because the risk will happen pretty fast, like it did right here. 9, a bear bar closing near its low, but not all that great. If this is such a good sell the close bear trend, why are we getting a decent bull bar, and why are traders selling a 50% pullback? If you're in a strong bear trend, traders should be selling at the market, not a 50% pullback. And if you look, even on bar 10, we get to a 50% pullback of bar 9. So traders weren't looking to sell below 9, and on the close of 9, they were looking to sell a pullback of bar 9. You might have even gotten a pullback of, technically your stop would be above the 8 high. And that's exactly where it went to. Pretty much, it went one tick past, meaning those limit orders at the 50% got filled, and then we got another leg down on 10. But if you sold the 50% correction on 10, you got filled somewhere up here, and you were able to make 10 points in one bar. And a lot of traders, if they're able to make 10 points in 5 minutes, especially on the open when, this is pretty climactic, you have a big tail here, a big tail here, a big bull bar here, and a 50% pullback, and you just sold a 50% pullback, and now you're low in the range, a lot of traders are going to see that they have a 10-point profit and just accept that it's a gift and take it. Reversal up on 11. It's a type bear channel, so not good, and it's probably a trading range. So bulls who are buying probably have a wide stop and are looking to scale in lower on the premise that, if it's a trading range, gaps should close, and it's reasonable to think this gap is going to close. But I think that the initial target is essentially the open of bar 9, since that's the high of the most recent sell climax. But I think 11 is probably a minor reversal. Bad follow through on 12. Essentially just a doji bar and a bear close. 13 fails to close strong, and a lot of the bear bulls who bought, they bought scaled in lower. They were hoping 13 was going to be a big bull bar, and when they got a disappointing close, they'll just exit the market, and that causes 14. There were probably buyers below here. Limit order bulls have started making money. They bought this breakout, made money, so they're going to buy this breakout again and probably make money. Limit order bears make money, so stop order bears will probably make money at some point soon, but that doesn't necessarily mean they have to make money right now. So you get bad follow through. So you get 14, a bear bar. Some bulls will scale in below 14, just betting that you're going to get bad follow through. It's a trading range. And you get a reversal up on 15, but a big tail. I think 16 is a bit of a surprise for the bears. I was not expecting them to get such a strong bar closing so near its low. And you get follow through on 17, and it turns out 16, 17 is just a vacuum test of that 50%. It's also consecutive sell climaxes: 1, pullback, 2, two-legged correction, 3, and the third subdivided into 2 legs. But there's a lot of reasons not to be selling down here. I think you're also selling again. 1, 2, 3. You're selling a wedge bottom. You're selling low in a trading range or low in a bear channel. So it's really not all that good. Reversal up bar 18. Probably still a minor reversal, but likely good for 2 legs sideways to up, which you can see we got 1, pullback 2. And probably, it's reasonable to think we're going to get to the top of the most recent sell climax, which is right here. Follow through on 19, not great, but not terrible. And you can see 20 overlaps a lot of 19. It's important that the tail of 20 overlaps the 18 high. It means that bulls bought the breakout test, but you usually want to see like a little gap here. So, it wasn't quite able, you can see how the tail on 20, what I'm saying is test the 18 high. And you don't want to see that because the 18 high was the buy. And after a bull bar, you don't want to give bulls another chance to get in. You want to make them chase the market up. And since 20 overlapped that 18 high, the limit order bulls were able to buy and get in, meaning that this was not going to be as strong, especially with all the overlap on the tail of 19, tail of 20. Bull bar on 21, but a doji bar, so really not all that great. Usually when you get a doji bar and a buy the close rally, it means that it's probably going to come to an end within 3 bars. You can see it essentially did. Some traders were hoping that we were going to rally straight up, because sometimes when you get channels down, the reversal, essentially, the retest is something like a doji, and then you get a rally that goes straight up. But I think the problem with that is that this bear channel is really, really tight, and we haven't gone sideways first. So I think we need to go sideways more before we get a reversal. Additionally, 22 does not close on its high. If 22 had closed on its high, I think it's more reasonable to think that we're going to get, we might break out to the upside. And I was thinking, if 22 closed on its high, we might end up getting to the 9 high, since that was the next target, or the 9 open. That was the next target, since there's the top of the most recent sell climax that hadn't been tested. But if we get there, we might just get to the 1 low as well, since the 1 low and the 8 high are an open gap. As a side note, for next week, I think that the 1 low of today, so I think that this low is going to be resistance. So if we get up here at some point next week, especially Monday, I would expect to find sellers here. 22, bad follow through for the bulls, like I mentioned, and disappointed bulls who were front running, exiting around break even during 23, causing the sell off. Probably buyers below 22, but the pullback could be deep. And again, we're towards the top of the trading range, so it's not really all that good. 24 trades above 23, but probably sellers. Same thing, 25, sellers above 24. And then you get a huge bear bar, 26, closing, at its midpoint. 26 is good enough for a second leg down, but it's probably not going to be all that great. You're getting pretty much a big tail on the bar, and 18 through 25 was strong enough, really tight channel is strong enough that's probably going to get another leg up. You could argue that 26 is the second leg down from the big channel that we had from 4 to 17, but I think this is a big enough bar to damage the bull case that we're probably going to go mostly sideways for the rest of the day. The reason being, the bull channel from 18 to 25 is tight enough to make me think we're not going that far down. That far down. And the bear move down, including 26, is strong enough to make me think we're not going that far up. 27, an inside bar, but bear doji, really not all that great. 28, essentially an outside bar, but another doji bar. You're towards the bottom of a trading range, so it's really not all that great. We get an II pattern, 29 and 30. This is just a tight trading range, 27 to 30, but you can look at it as an II. But a lot of times, again, when you're deep in a bear trend, which you could argue we're deep in a bear trend, and we had a trend line break right here. So trend line break deep in a bear trend, one more leg down, and you're looking for a higher low major trend reversal at this point. And you get an II, but the reality is the II, it's probably going to fail to the downside. Bears are hoping that 31 closes on its low, and then you get big follow through on 32, and you start getting bars that look like 6, and you just get a massive collapse, but it's probably not going to happen. And so you get bad follow through on 31. Traders exit at the market. That causes 32. And you can see we start to rally to the upside. 32, 33, and 34 all have tails on their highs, which tells you that on a lower time frame, it's probably a parabolic wedge, because wedges have essentially 3 pullbacks in 3 different legs. And you can see we went up and down 3 times between 32 and 34. So makes it likely that we're probably going to pull back. If you look at 35, it's essentially a pullback after a parabolic wedge, but parabolic wedges are minor reversals. So with how strong, the channel is pretty tight. So it makes you think that, 35, probably a minor reversal at best. We are forming a triangle. We did form a triangle, but just something to note that this is probably a minor reversal. And that's why you get bad follow through 36. I think you can buy above 36. You're probably going to go sideways. You probably have to have a stop at least below here. And if you buy above 36, you probably just have to hold through all of this and be willing to just buy and walk away. Assume you got 2 to 1 of your true risk, maybe even better. Yep, better. So the high of this was where the 2 to 1 of those traders' true risk was. That's not a coincidence. So you can buy above 36, citing that you essentially got a trend line break. And now you're getting a higher low, potential major trend reversal. Follow through on 37, but it's pretty bleak. It's a doji bar. And 38, double bottom with 36, but a bear bar. Bull bar on 39, but you can see bears were able to keep it from triggering. However, this is a triangle. We're going to get a breakout. The bears, we're probably not going much lower. This all looks like a trading range. It seems like low probability that we're just going to get another breakout to the downside with how strong the bulls have been in a lot of areas today. Again, you're getting strong closes here, like 2, like 8, like 11. But I don't think, I was just thinking about the 11 buy a lot today because, on days like this, you think, well, it's a tight bear channel down. Nothing is as bad as it looks. Maybe this is an okay buy, and you're right. But I think it's because 1 and 2 are so strong that you can take this sell. And you can take this sell because these bars, this is a strong bear bar. This is a big, strong bear bar. Versus over here, bulls aren't making any money, and there was no strong bull statement early in the day. So it makes that a much worse buy. 39, 40 inside bar and a big breakout on 41. My problem with 41 was, 1 push up, 2 pushes up, 3 pushes up. So you're buying a climactic 3rd push up towards the top of the trading range, and you're buying right at the 25 low. And like I mentioned, the traders who bought below 25 probably scaled in lower and are trying to get out of their first entry around break even. And that's probably what's going to happen. So I don't think it's really all that great to be buying up here. And the 40, traders got trapped above 40. And those traders will probably get out around break even because it's a trading range. Bad follow through 42. Since it's 3 pushes up, you could argue that this is a wedge top, but 42 closes in the middle of the range, probably more buyers below than sellers. And it closes in the middle of this tight trading range. And then you get 43 closing near its high. I think I wanted to essentially buy the breakout and hope for a measured move up. We did end up getting this measured move up towards, obviously, like I mentioned, this high, which is not a coincidence that it was there. You could have bought above 43. You could have bought the follow through 44, 45. But you have to note that the follow through is not all that great. And a lot of traders might scalp with 5 points. And I bought the breakout above 42, which, I was buying high in a trading range. I recognize that. And I was willing to get out pretty much below any strong bear bar if we got it, but we never did. And I just took half off at 5 points. I think especially in a trading range day like this, you need to be willing to scalp a piece at 5 points because, you kind of bad follow through 44, kind of bad follow through 45, a bear bar 46, and tried to form a micro double top 47 at the top of the trading range, but was not able to close strong. Bull bar 48, doji bar 49, so it's an II pattern. But, I noticed that the channel up was pretty tight, so I thought we could go for a little while. 50, a bull breakout, but, how have bull breakouts done so far today? All of the strong breakouts have bad follow through. Strong breakout, bad follow through. Strong breakout, bad follow through. Strong bar, bad follow through. So good bar, but probably going to get bad follow through like it does on 51. Probably don't have to exit below 51. We're probably, it's just probably minor at best. You're still in a tight bull channel. Expect the reversals down to fail. Follow through for the bulls 52, bull bar 53, continuing up 54, 55. Again, tight bull channel, but the problem with bull channels is bull channels are bear flags. So when you're buying in a bull channel, you're actually, you're buying a bear flag. And for that reason, you need to be pretty quick to get out. Like you get this outside up bar, probably put a stop below 57 or a point or two below 57, because otherwise your stop is all the way down here. And the risk is too big if your stop is all the way down here, once we're all the way up here. And, additionally, once you see 58, it's a doji, we're testing magnets, right? So you really don't want to be, it's not ideal to be long up here. So you need to be quick to get out. Otherwise, you get a big bar like 59 and it's going to stop you out. Notable that the tail on 60 did not touch the 58 low, meaning that traders who bought below 58, obviously disappointed 59, not able to get out during 60. So some bears take the sell below 60, hoping for fast follow through, which they get 61. Assume they're able to make 5 points. Yep, they're able to make exactly 5 points. So the bears who sold below 60 scalped out with 5 points. 62, a reversal up, but, not all that good, tight channel down. And then essentially we got spike and channel. Like I mentioned earlier, we got spike and channel. So spike and channel down for a measure move of the spike. 63, a low one short, bad follow through for the bears, but it's a tight channel. 64 trades above the top of the channel. So I think it's a weak stop to have your stop above 63 at this point. It should probably be above 61. Or in just exit above any bull bar. Follow through 66, 67, traded above 58. You could argue that it's, down 1, down 2, down 3. So some sort of wedge, but really just essentially 71 trying to break out below the low of the channel, vacuum test down to that measured move, and a reversal up 72, 73, double bottom 74. And you can see we got back to the 60 low. On the daily chart, essentially double top with this. So, low one, pull back, low two, double top for the bears, hoping that we triggered the sell below this on Monday and we get a big giant bear bar. On the weekly chart, disappointing bar, I think, for the bears, but also not the best bar for the bulls. I think we're going to start some sort of channel here. We might pull back more. I think we probably will pull back more before we start the channel, but ultimately I do think we're going to get a channel up. We could just be in an overall channel like here, and this could be the bottom, maybe. I don't know, somewhere down here. One of these bottoms could be the bottom. So we might have to pull back a bit overall. Yeah,